Gold just hit $4,616 an ounce, and most analysts still think this is a bubble. Let me show you why they are wrong, and where I actually think this goes by the end of 2026. Because the viewer questions coming into this channel right now are all versions of the same thing. Is $5,000 realistic, or is this thing topping out? That is exactly what we are going to answer today, with data, not vibes. So here is the first thing most people get wrong about gold at these levels. They look at $4,616 and they compare it to where gold was a year ago, or 2 years ago, and they say, it has already run too far. But that framing misses the structural story completely. Gold in real terms, meaning adjusted for the CPI index, which currently sits at 332.813, actually underperformed against its 1980 peak for more than 4 decades. The 1980 high of $850 an ounce, adjusted for the official CPI today, is equivalent to roughly $3,400 in today's dollars. So gold, even at $4,616, is only now genuinely breaking into new all-time high territory in real purchasing power terms. That is not a bubble signal, that is a long overdue repricing. Now let me bring in what the analysts are actually saying, because there is a sharp divide right now between the mainstream financial press and the macro analysts who have been tracking this the longest. Goldman Sachs revised their end of 2025 gold target to $3,700 back when gold was trading around $2,900. They have had to revise upward 3 times since. That pattern matters. When the largest investment banks are consistently behind the move, it tells you something structural is happening that their models are not built to capture. Their models are built around real yields, the dollar index, and ETF flows. What they are consistently underweighting is the sovereign demand story. Central banks globally bought more than 1,000 tons of gold in 2022, again in 2023, and again in 2024, 3 consecutive years above 1,000 tons. Before 2022, the last time central banks bought at that scale was literally the early 1970s, right before the dollar broke from the gold standard entirely. That is the historical parallel nobody in the mainstream wants to say out loud. Now, on the other side, you have analysts like Luke Groman at Forest for the Trees arguing that the US fiscal situation has already crossed a point of no return. The US is currently spending more on interest payments on its national debt than it spends on national defense. Let that land for a second. Interest expense has now overtaken the defense budget. Groman's argument, and honestly I find it hard to push back on, is that the Federal Reserve is trapped. The Fed funds rate right now sits at 3.63%, that is still restricted by historical standards, but the government cannot afford for it to stay here long without the debt spiral accelerating. And if the Fed cuts aggressively to relieve fiscal pressure, they risk reigniting an inflation that the CPI at 332.813 tells us was never fully extinguished. Real GDP growth at just 1.5% means the economy is not growing fast enough to inflate its way out of the debt the clean way. So you get a Fed that is caught between a debt wall and an inflation floor, and gold is the asset that prices that trap. Here is where I push back slightly on the most bullish voices, though, because intellectual honesty matters here. Analysts like Jan van Eck and some of the more excitable corners of the gold commentary space are throwing out $5,000 targets for 2026 as if they are certainties. I do not think this market runs in a straight line. It never has. Gold fell 45% between 2011 and 2015 after a major secular bull run. It dropped nearly 15% in a matter of weeks during the March 2020 liquidity crisis, even while the fundamental case for gold was probably the strongest it had ever been. So the question of where gold ends 2026 is not just about the macro case, which I think is genuinely strong. It is about the sequencing of events and whether we get a risk-off liquidity shock that forces leveraged players to sell everything, including gold, before the real leg higher. That said, here's my honest take on the end of 2026 question that so many of you have been asking. I think the range of $4,000 to $5,000 is not a bold call at this point, it is the baseline. The bold call, The one I think actually has a real probability that most people are not pricing in, is a move above $5,000 in the back half of 2026 if we see one of two triggers. Either the Fed is forced into emergency rate cuts by a credit event in the Treasury market, or we get a second inflation wave that breaks the public's remaining faith in the dollar as a store of value. Either trigger is not a tail risk anymore. Both have been priced into sovereign behavior for the past 3 years. The central banks are not buying 1,000 tons a year because they think inflation is solved. Let me give you one more data point that I almost never hear discussed in mainstream coverage. The COMEX gold market, where most of the paper price discovery happens, has at times operated with a coverage ratio exceeding 100 to 1. That means for every 1 ounce of physical gold actually deliverable in the vault, there are more than 100 paper claims on that ounce. If even a small fraction of those paper holders demand physical delivery simultaneously, the pricing mechanism breaks. We saw a smaller version of this dynamic during the London gold lease rate spikes in 2025, when the spread between London spot and COMEX futures blew out to levels that had never been seen in modern history. That was not a glitch. That was the system showing you its seams. And here is the thing about high-yield savings accounts currently advertising up to 4.15% APY, which a lot of people are looking at as the safe alternative. If official CPI is already at 332.813 and real GDP is only growing at 1.5%, the real return on that 4.15% after taxes in a higher bracket is barely positive, and possibly negative once you account for the full cost of living increases that CPI does not fully capture. Gold has returned more than 700% since 2000. A savings account has not compounded at anything close to that over the same period. That is not an argument to put 100% of anything into gold. It is an argument to understand what money actually is and what it does over time. So where does this leave us? Gold at $4,616 is not the top. It might not even be the middle. The structural forces driving this, central bank de-dollarization, a Fed caught between debt and inflation, a paper-to-physical ratio that cannot hold indefinitely, and a real yield environment that makes dollar cash increasingly unattractive, none of those have resolved. All of them have deepened in 2026. The mainstream will keep calling tops right up until the moment they start calling it inevitable, and by then the move will largely have happened. Which side of that realization do you want to be on? If you want a daily unfiltered look at the data behind gold, the Fed, and the macro picture before it hits the mainstream, subscribe to this channel. Most people find out about these moves after the fact, when the easy money is already gone. Every upload on this channel digs into the numbers before they hit the mainstream headlines, so you can form a real view instead of reacting when it is too late. Hit subscribe and turn on notifications so you do not miss the next one. Just to be straight with you, I am not a financial advisor, just someone who reads too many macro reports and finds this stuff genuinely fascinating. Everything here is my own research and my own opinion, so take it as one perspective and always do your own thinking before making any decisions.